In November of 2013, one nation was holding about $1.316 trillion in United States government debt. It stood above every other foreign holder on Earth, more than Japan, more than the United Kingdom, more than all petroleum exporting countries combined. That nation was China. By present official figures from the United States Treasury Department, that position has been reduced by about half, falling to around $650 billion. The reduction has not been abrupt or widely publicized. Instead, it has unfolded steadily over more than a decade, with monthly adjustments that often appear small on their own but accumulate into a major structural shift. This is not a sudden exit that triggered immediate headlines. It is a gradual and consistent reduction carried out over years, subtle enough that it rarely drew broad public attention. While debates in the United States centered on tariffs and trade imbalances, the country that once financed a large portion of American federal borrowing was already scaling back its exposure. According to data monitored through CEIC economic tracking systems and based on United States Treasury reporting, China's holdings reached their highest point in November of 2013 at $1.316 trillion. From that peak, the downward movement has been persistent. By February of 2026, Treasury records indicated holdings near $693.3 billion. In March, the figure moved to $652.3 billion. By April, it was recorded at $651.1 billion. The overall reduction from the peak stands at roughly 50%. The pattern is not defined by sudden liquidation. One report referencing Energy Newsbeat and Treasury data described a February 2026 adjustment of just $1.1 billion as a controlled reduction rather than panic-driven selling. The emphasis was on intentional repositioning instead of crisis behavior. China, once the largest foreign creditor to the United States government, now ranks third among overseas holders. Japan currently holds about $1.24 trillion in U.S. Treasury securities. The United Kingdom holds approximately $897 billion. China sits behind both with roughly $651 billion. Out of an estimated $9.49 trillion in total U.S. Treasury securities held by foreign investors, China's share has fallen to around 7%. At its earlier peak, its influence represented a significantly larger portion of global foreign holdings of American debt. In total terms, the reduction from the peak amounts to about $665 billion removed from U.S. Treasury exposure. Congressional Research Service data notes that the United States paid approximately $282.4 billion in interest to all foreign holders combined in the year 2025. China's reduction alone exceeds that annual global interest payment by more than twice. In early 2026, the pace of reduction continued. Reports citing internal guidance within Chinese financial regulatory circles indicated that domestic banks were encouraged to reduce or limit their exposure to U.S. Treasury securities. The stated concern centered on concentration risk. This type of directive signals more than routine portfolio adjustment. It reflects a policy-level reassessment within China's financial system regarding long-term exposure to U.S. government debt. Rather than informal caution, it represents structured guidance intended to influence institutional behavior. China's continued reduction of Treasury holdings is one layer. Another is the instruction to domestic institutions to avoid expanding those positions. Together, they suggest a coordinated shift in financial strategy rather than isolated market activity. The question of where the capital has been redirected leads to another consistent trend. Over time, attention has increasingly moved toward gold accumulation. Data compiled from disclosures by the People's Bank of China shows a continuous buying streak extending for 17 consecutive months as of March 2026. 38 million fine troy ounces of gold are now part of the discussion, as gold makes up about 9% of China's total foreign exchange reserves. A decade earlier, its share was significantly smaller. This is not a marginal allocation. It is a gradual, repeated shift across years and months, moving capital away from assets tied to a foreign-issued currency and into a physical store of value that cannot be restricted by sanctions, executive action, or legislative decree. China is not acting in isolation. Data from the World Gold Council shows that global central bank gold purchases have reached a record annual level of nearly 5,000 tons. Over the past decade, China, Russia, India, and Turkey have consistently been identified as the leading buyers. Market projections from J.P. Morgan estimate that gold could move toward $4,000 per ounce by mid-2026. That outlook is linked directly to continued accumulation by central banks. The underlying mechanism is straightforward. Central banks do not acquire gold for yield. It produces no interest. Its value comes from something different. Unlike a treasury security, it does not depend on repayment by any government. It is not a promise issued by a state. A U.S. Treasury bond represents an obligation from the United States government to repay its debt. Gold represents no obligation at all. It is not tied to policy decisions, currency issuance, or financial commitments. It exists independently in physical form, stored in vaults, unaffected by sanctions frameworks, inflation policies, or external financial pressure. Attention to this distinction increased significantly after the 2022 invasion of Ukraine, when hundreds of billions of dollars in Russian central bank reserves were frozen within a short period. That event is widely cited by economists as a key moment when central banks reassessed the risks associated with holding reserves in foreign currencies. From that point onward, the perceived safety of sovereign foreign assets began to be reconsidered at the institutional level. A broader layer of analysis comes from research published by the Council on Foreign Relations by economist Brad Setzer, who has focused extensively on China's external financial exposure. His work suggests that official U.S. Treasury figures do not fully capture China's total dollar-linked holdings. According to Setzer's estimates, when accounting for assets held through third-party custodians, U.S. agency debt, and indirectly managed equity positions, China's exposure to U.S. financial assets still represents roughly 50% to 55% of its total reserve portfolio. This implies that the reported decline in direct Treasury holdings does not necessarily reflect a proportional reduction in overall exposure to U.S. assets. Instead, it suggests a shift in how those assets are structured and recorded. A significant portion of Chinese holdings has historically appeared in custody data under Belgium rather than China, due to purchases routed through Euroclear, a custodial system based in Brussels. Setzer's analysis indicates that China has recently been reducing exposure not only to U.S. securities, but also to the Euroclear and Belgium custody channel itself. The reason is linked to prior instances where similar infrastructure was used in the freezing of sanctioned state assets. The implication is structural. It is not only about moving away from dollar assets, but also about reducing visibility and centralized points of access that could be used in a sanctions scenario. China's approach, therefore, involves both reducing direct Treasury holdings and restructuring remaining exposure in ways that make it less transparent and harder to isolate within global custody systems. This suggests preparation for a scenario in which access to reserves could be restricted in a similar manner to what occurred with Russia in 2022. Setzer's research further estimates that Chinese state commercial banks may hold around $400 billion in foreign securities that are not fully captured in standard custodial reporting. This indicates that the total scale of China's exposure to U.S.-linked financial assets is larger and more complex than headline Treasury figures suggest. For policymakers in the United States, the visible decline in reported holdings may appear orderly and gradual. However, the underlying structure of those holdings is simultaneously being reorganized in ways that are less transparent and more difficult to track externally. The question of who has replaced China in holding U.S. debt leads to another set of structural considerations. Japan is currently the largest foreign holder of U.S. treasuries, with approximately $1.24 trillion. However, Japan's position is closely tied to conditions in its domestic bond market. Its holdings have fluctuated between roughly $1 trillion and $1.3 trillion over time, adjusting in response to internal financial dynamics rather than a fixed external strategy. The United Kingdom holds about $897 billion in U.S. Treasury securities. Much of this exposure is linked to London's role as a global financial hub, functioning more as an intermediary market than a direct sovereign funding decision. The key underlying reality is that the largest foreign holders of U.S. debt are not uniformly acting out of coordinated strategic alignment with United States fiscal needs. Instead, their positions are influenced primarily by domestic financial conditions in Tokyo and London. As a result, the stability of the largest remaining holders depends on internal economic structures in Japan and the United Kingdom, rather than on any direct alignment with U.S. fiscal policy. Every U.S. Treasury bond that China does not purchase must be absorbed by another buyer. That is the structural reality. And, as has been discussed in broader reporting from this channel, the base of dependable foreign government buyers has been narrowing at the same time that U.S. borrowing requirements have expanded beyond $2 trillion per year. When the largest and historically most stable category of foreign demand for government debt quietly reduces exposure and at the same time slows new acquisition, the immediate outcome is not collapse. It is a gradual upward movement in the yields that the Treasury must offer to attract remaining demand. That slow rise in yields does not stay confined to government auctions. It spreads through the financial system. Treasury yields act as the reference point for pricing nearly all forms of borrowing in the United States economy. Mortgage rates, auto financing, and credit card interest are all indirectly anchored to that benchmark. There is another effect that is less visible but equally significant. It does not appear as a line item on a loan statement. It appears in purchasing power. When higher yields are required to maintain demand for government debt, one historical response has been a greater tolerance for inflation as a way to reduce the real burden of that debt. Inflation reduces the effective value of what the government owes. In a system managing deficits near $2 trillion annually while facing a gradual withdrawal from its traditional creditor base, the incentive structure tends to favor inflationary adjustment over immediate fiscal correction. This dynamic is not theoretical. It has precedent in the 1970s, after the closing of the gold convertibility system. During that period, ordinary households experienced rising prices regardless of whether they were directly engaged in financial markets. Basic living costs such as groceries, rent, and savings value were all affected, even for those with no direct exposure to monetary policy decisions or reserve asset movements. To understand the broader trajectory, it is necessary to revisit an earlier historical episode in which a similar structure began to break down. In February of 1965, French President Charles de Gaulle publicly stated that France would begin converting its dollar reserves into physical gold at the official exchange rate established under the Bretton Woods Agreement. His position was shaped in part by economist Jacques Rueff. De Gaulle criticized what he described as the exorbitant privilege of the United States, referring to the unique position of the dollar as the world's reserve currency. This status allowed the United States to borrow and run persistent deficits under conditions that would typically trigger market discipline for other nations. France proceeded to convert its dollar holdings into gold over time, gradually and systematically, moving bar by bar across multiple years. The underlying vulnerability in the system was described earlier by economist Robert Triffin in 1960, known as the Triffin dilemma. He explained that global demand for reserves required the United States to continuously supply dollars to the world economy. That supply could only expand through sustained deficits, meaning more dollars leaving the U.S. than returning. As foreign holdings of dollars increased, confidence in the United States' ability to redeem those dollars in gold began to weaken. By 1966, non-American central banks collectively held around $14 billion in claims on the United States. At the same time, U.S. gold reserves stood at approximately $13.2 billion. Of that amount, only $3.2 billion was legally available to cover foreign-held claims based on historical Federal Reserve and academic records. This created a structural imbalance in which full redemption would not have been possible if all claims were exercised simultaneously. Although that scenario did not occur all at once, redemption pressure gradually increased. In March 1968, the London Gold Pool, an arrangement among central banks designed to stabilize the gold price, collapsed under sustained demand for physical gold. By May 1971, West Germany exited the system, refusing to continue exchanging its currency for dollars under existing conditions. Shortly afterward, the dollar declined by more than 7% against the German mark. In early August 1971, France escalated its position further. President Georges Pompidou authorized the dispatch of a French naval vessel to New York City with the purpose of retrieving France's gold holdings from U.S. custody. Within days, on August 12, 1971, Britain requested $750 million in gold redemption. Just 3 days later, on August 15, 1971, President Richard Nixon announced in a national television address that the United States would suspend the convertibility of dollars into gold for foreign governments. That decision effectively closed the gold window, ending the convertibility system that had supported the post-war monetary order. The consequences unfolded over the following decade. With convertibility removed, monetary conditions loosened relative to the constraints of the previous system. Inflation, which had remained near 2 to 3% throughout much of the 1960s, rose into double digits by the mid-1970s and persisted into the early 1980s. Gold, previously fixed at $35 per ounce under the official system, was released into open market pricing. It rose sharply, surpassing $800 per ounce by January 1980. That represented more than a 20-fold increase within less than a decade. Those who had converted holdings into gold before the breakdown of the system preserved purchasing power through the transition, rather than experiencing the full impact of the monetary shift. The historical sequence demonstrates how changes in reserve confidence, debt structure, and external demand can reshape global monetary conditions over time. Stay informed on how shifts in global debt, reserves, and monetary systems continue to evolve.